You'll get an email usually from Steve Fulgham, you know, a week or two into the month and say that the financials have been posted. So at that point in time, you can go out to the intranet and you'll move over to your financial and then go to Outlook Soft Financials. You will see something similar to this. You will need to pick the branch you want to look at or your territory. So you would come over here to the left-hand side where you see where it says branch, this hyperlink right here. Click that, and you will see this screen. So at this point, if you wanted to select just one branch, you could put in, you know, Hattiesburg, hit add, and it would go straight to it. As you put them in, they'll stay there until you reboot your computer, and then you'll have to go back and add them again. But you can see your territory, this little plus sign over here to the left. You click the little plus, and that'll open up these territories. So you'll say CNI Allen Bradley, CNI Squared E. For example, we hit the plus sign, open it up one more time. This is all CNI AB, so now we see that your individual territories. So, you know, Robert, this would be you, and Homer, Mary. So, like, for example, Mary, it says CNI Decatur, but that's actually Tupelo, Columbus, and Decatur. So to pick a branch, we'll say open that up, and let's look at Hattiesburg. So it'll take you back to this screen. Now the other thing you'll have to do sometimes is select your time frame. So it works the same way. So I hit time, and you'll see all these years. So you hit the little plus sign. And this is like if you want to go back and see a past month or year or whatever, the plus sign on the 2017, and you got there's the first quarter. So if you happen to hit, like, say, March, you're going to see something like that. That means March is not closed out. It's not ready yet. So to pick February, go to the first quarter, hit February, and now you'll see up here it says 2017 February, Hattiesburg. Your P&L Statement of Operations is under this PDF Reports desktop. So I click that, and you will see two versions. You got the summary and you got detail. Summary is a one-page snapshot of either your territory or a branch. So if I had picked a territory, this right here would say CNI Jackson. You know, that would be all your branches rolled up. So we're looking at just Hattiesburg on this one. Go full screen by clicking this little on the right-hand side over here to make it full screen, and then maximize it. Now you see, if you was to print this out, that's a good summary sheet. You know, some people print them out, put them in a binder. All the big things are rolled up into big buckets. So your income, for example, if I look at this part right here, this is all your income. So this is your total sales, direct, through stock, whatever, by actual period and prior period. So this is actual February, and this is February 2016 is this bucket, or this right here. And that's a percentage change. So it's 24% down from last year at this same time is what this percentage change is. You'll come across and you got actual year to date, prior year to date. So we're 2% up from last year at this point in time. When the budget is loaded, which is not yet, you can see they're all zero, you'll see the budget, what it should be year to date, and the change. You know, how far off you are or above or below budget. So you got gross margin. It's cost of goods sold. That's your cost. Here's your margin. Then you'll see some cost of goods sold, inventory adjustments. That includes a lot of different, you'll see in the detail, but that's a lot of stuff rolled up in there. Your vendor incentives, which is your rebates, you know, from manufacturers along the way. There's your total adjustments, and you got total income to operations and some other income. You got your total income.
And Tommy.
Yeah.
Hey, Tommy, just to verify, the negative is actually a positive dollar, right? When you're looking at inventory adjustment?
Yes. Right. Okay. And like I said, that includes some other stuff. It's not just, and you'll see down when you get into the detail, there's a category called inventory adjustments quantity, shrinkage or overage of inventory through just adjustments. But that's all rolled into this number. Then you go into your expenses from here down to here. So that's your big buckets, of course, is employee comp, sales and marketing. With sales and marketing, that's your T&E, golf, whatever is in this one. Facility could be anything from HVAC repair, rent, delivery expenses, direct expenses. So that's your total expenses, and then you get your operating income. So you take your total income minus your expenses, and you come up to this number. Then we get into other expenses and allocated expenses. And I thought, because there's always some ambiguity, I guess, on what this stuff is. So I did this to kind of explain how they come up with those numbers. So direct expenses, I showed you that. That's your comp and your normal stuff, utility bills, whatever. Other expenses, which you saw over there is one of those categories, is discounts allowed to customer and your RDC allocation. That's the number you see that's probably going to go down considerably. That number went way up for a lot of people as the cost of the RDC went up as we did cross-dock. You saw this number jump, over $1 million for the company. But that's where that number is, your RDC allocation. Then you've got allocated expenses, which that is collections, rebate department, purchasing, DSM, DOM, all the expenses, their salaries, all corporate type. These departments are in this allocated expenses. And then you've got corporate allocation, which that's simply 1.75% of your gross sales. So you can take your gross sales, take 1.75% of that, and that's going to be that number. That's basically like your corporate overhead. That's just a flat number that everybody pays. So now you take that away, and you come up with your net income before corporate allocation. And like I said, the corporate allocation, which I showed you over here, is this one. That's your 1.75%. So now we take that, and we come up that you take all that away, and you come up now as your corporate EBIT. There's your EBIT dollars. So you can see Hattiesburg is February actual year to date has got a positive EBIT dollars of $135,000 after all those expenses were taken away. Last year at this time they were $80,000. Okay, then you got AR delinquency. That's your accounts receivable delinquency. You want that to be in the 30 to 40, 30% on industrials typically, 40% on contractor is considered doing pretty good. And that's, again, in this point, you're not saying year to date, you're just saying actual period to prior period. So last year 30%, this year 44%.
Hey, Tommy.
Yeah.
Is that the amount of delinquency past their terms? So if it's 30-day terms, it means it's past 30 days for a given amount of AR?
Right. Yep, it's anything delinquency, and it could be just a short period of time over, and it's still going to be in that roll up into that. So it doesn't matter if they're past terms; they're considered delinquent. And this, of course, accounts receivable. That's your total, just the total dollars is what we're showing here. Days of inventory used to be, if you were 60 to 80 days, you're doing pretty good. Since we went to cross-dock, you'll see that a lot of this. You'll see these numbers a lot lower. You can see here 38 and 49. I mean, that's pretty low, but that's at the branch. So that number, if we move away from cross-dock back to more inventory at the branch, you'll see this number, days of inventory, go back up. So, 60 to 80 days is typically considered pretty good. Your G items, this is your dead stock, anything G, which is a Eclipse ranking method. So anything G or over is considered kind of dead, slow. You want, the number there, you want a downward trend. So here you can see this kind of went the wrong direction. We went from 9% to 13, 14%, which is not what we'd want to see. I don't know the actual goal. I asked Nicole, and she didn't know off the top of her head either, but we just want to see a downward trend, get less D items, of course.
Tommy, on that too, I've heard less than 15% is okay, but also an item will automatically fall into a G if you bring it into stock new. So if you bring in a new line or a new product, it immediately hits as what's considered a G item in the system. So that sometimes can skew that percentage also.
Yep, that's a good point. That is true, because it has no real movement when you bring it in new like that, and or if it's an old item that had a ranking that you brought back in stock for whatever reason, it was dead back then, it'll come in dead. So it's more of an indicator, kind of you want a downward trend, and if you're 25% G items, and you've probably got a problem, but I would not consider this terrible right here. Your branch inventory turns, again, because of cross dock at the branch level, you're going to see these turns go up considerably. I mean, used to, 5 plus was great, and you can see here Hattiesburg is 9.5. I've seen 10, 12. As we move inventory back, 5, 6 turns would be considered okay. The more the better. Then your inventory valuation, you can see it went down from last year. Then you got working capital, which that typically in the past has been on like bonus plans. I don't know. I don't know what they'll be this year. Working capital, you want it to be between 20 and 23% is considered pretty healthy.
And that is calculated by dividing your gross sales into your quarterly AR plus inventory.
This is pretty good. 20, these numbers right here. So that you may see that could be on a bonus. I don't know. FTEs, this is basically the number of employees. I don't know why that's nothing. There must be something wrong right here, because I'm not sure. It's 17 last year, and there's nothing here. So comp to income is a number they used to harp on a lot. I haven't seen that one in a while. Usually around 50% or less is what they look for, comp to income. So this one actually looks pretty good. Margin per FTE. Nicole said the company looks for about a 5 to 6% growth, increasing margin per FTE. Then let's move down to your corporate EBIT. Again, that's that same number you saw up here. This is your corporate EBIT dollars, and this is your EBIT percentage. So
to calculate that, you divide your gross sales into your EBIT dollars, which will give you your EBIT percentage.
And that gives you the percentage of a little over 8%. And of course, our goal is 5. You can see last year it's 5.5%. This year, on this same point in time, is 9. So that's a very good trend. 5 to 8 right here. Drop through is coming on this report, according to Nicole. Drop through is, and like I say, she said it's going to be added to your P&L, and I would think it's maybe on the bonus. I don't know, but the way you calculate that, number one, you have to have a positive increase in your EBIT year over year, and a positive increase in your total income to operations. So if you have a negative, if you go down from one year to the next, you can't really calculate. There is no drop through, so it's basically zero. So in this example, this is just a 1 month period we're looking at here. This is something Nicole actually did years ago, and I dug it up and found it, but it's I think a pretty good example. So you've got current period, the EBIT dollars was $208,000. Same period last year, 223. So that went down. So, and then you got total income. You got 506 current period. Same last year is 463. So that increased. So now you've got your EBIT year over year. So you got this negative number right here. And like she mentions right here, if any calculations parts 1 through 6 are negative, then enter 0. So then you got your income, you got a $42,000 increase, but because this is a negative number, you have no drop through. Now we come over here to this year, we see we go from 1.3 million to 1.6, so that's an increase. We go from 3.5 to 4.1, an increase. So you've got a $302,000 increase on your EBIT and a $611,000 increase on your income. So then you take your current income minus your last year's income. So you take the difference. So in other words, these two numbers here, and you divide the last year, the difference from that into the difference of your PBIT dollars. And that gets you your drop-through percentage. So basically, how much income you produced, they want 70%, 60 to 70% to go drop through to the bottom line. So in this case, in this example, this right at 50%. So what they're trying to do is say, okay, if you increase sales, you increase income, but then you increase your cost, your expenses too much, then if only 10% drops to the bottom line, then you've increased income, but you've eat up most of that with extra expenses. Say you hire some salespeople and they cost you a lot of money or whatever, and they produce some income, but their salary outweighs, and their commission or whatever, or they spend on T&E or whatever outweighs it, then you don't have much drop through. They want 70% of every dollar increase in income to go to the bottom line. So that's what drop through is. And like I said, you'll probably see more. Let's look at the detail portion. Same deal. It's down here at the bottom. This is your detail, same information, but now you'll see the breakdown of all your sales. So you've got, EDI, counter, inside, that's just basically inside normal sales, counter sales. This would be like the high tech stuff. Inside materials, it's normal C&I. Sales, this is your total, stock through warehouse sales. Anyway, he breaks down all the stuff, directs, cost of goods sold. All these big buckets are now broke out into individual accounts. And you see the account codes right here on the left. Like, for example, your inventory adjustments quantity. So that's actually inventory adjustments in or out. Then you got your vendor incentives right on down the line. So what typically when you look at this, you'd scan down through here and look for large discrepancies in what of course the budget numbers are not in here, so all we can look at now is last year and this year. So, a lot of this stuff is not, you can't do much about, but hotel, motel, last year was 5,700, this year 1,800. You went down on M&E, 8,700 to 5,500. So you just kind of scan through here and look for things that stand out that doesn't look right or is too expensive or whatever. So in this example, let's go down to 7358. Here, customer gifts and prizes. So last year, I had none. We got $2,300 here. Of course, if I had a budget and it was, like, say, if the budget was 1,000, I'd say, hey, how come this is higher than what I thought it was going to be? So to figure out what this is, you got to go to Eclipse, and you go to GL Inquiry. Now, this is a thing that in about probably 30 to 60 days, we should have this thing called Profix, which we're supposed to be able to look at your P&L and then click and drill in straight into the transaction level without having to go to Eclipse. But we don't have that yet, so they wanted to go ahead and show you what we got. This is a little cumbersome, but, it's all we got right now. So find your GL Inquiry. It could be under accounting. Our menus are going to be different, but find it and you go GL Inquiry. So we want to pull up this particular account and see what's going on. So you can either type in 7358, which is, the account number, or if you don't know the number, you can type in a partial name, customer gift, get you to the same place. So then we put in the branch, so it's 372 we're looking at. So just enter through the subledger, and it's going to ask you what fiscal year. So if we're looking at 2017, if you wanted 2016, you put in 2016. Hit enter. It'll spin for a minute. Now you're going to see in 2017, you see it starts in January, you're going to see all the debits and credits has been posted. You'll see, some journal entries, payables. So I'm trying to figure out, what's going on here with this expense. If I roll down to like this $1,130, I want to look at that one. So I put my cursor on that one. I hit Alt-D for detail. See down at the bottom, the detail? Alt-D, and then you'll come up to this screen, and you'll do Alt-V for view. And you'll come to the AP entry, which I can see now is Sam's Club. So I come down here to customer gifts and prizes, $1,130. Still don't know what it is. So I can click this I. Now this doesn't work this way. You have to kind of hunt and peck on this. It doesn't work as clean on all this stuff. Sometimes you just have to call accounting. But on this one, I click the I, hit enter on the first image, and they have scanned this Sam's statement in. And I know how it looks to you guys. I can't see it. It's not readable. But I printed it, and I could read it okay. So you just keep that in mind. Sometimes on the screen they don't look good. You can zoom it in, but you can't read it. But printed it looks okay. So I got in there. It says Mark Stevens, but at least it gives me, I know who to call or to make sure it's valid. Because you'll see if you look at the video I did, Jimmy Dickinson actually found a tax that got incorrectly posted to his branch twice in error. If he hadn't found it, it probably wouldn't have got fixed. But it was about $6,000. He got hit twice with. It was totally an error. So it's definitely worthwhile to look at your P&L to look for things that's out of whack. So anyway, that's how you can look at that one. And then say if I go down to this one, this $1,128, I'll do Alt-D. All right, now I see this one here for $1,021, and I say Alt-V, and I come up to this screen, and you'll see this a lot. This is a Visa, or actually their MasterCard. They still say Visa, but it's somebody's credit card. So the only way to really know who this is, you see this subledger field right here, this 88706. So at this point, I don't know who this is. So to figure this out, I've got to come up here and hit F1, and then go to vendor. And I type in .88706. That is Laura Brewer, inside sales. So that at least you can now go to that person and say, hey, what was this? If you don't remember, or you go look at their statement, you could go and concur and probably figure it out. But that's how you look up somebody's, tell for the subledger what credit card created this expense.
And that concludes our first WebEx on how to access and review your P&L. If you have any further questions, feel free to contact me. Thank you.